Hey there, everyone! Welcome back to our channel. If you're interested in real estate, taxes, or investing, today's video is just for you. We're diving into the world of 1031 exchanges. So, grab a snack, get comfy, and let's get started. Now, here's a question for you. Have you ever thought about how you could sell a property and reinvest the profits without paying a hefty tax bill? If you have, then you're in the right place. The 1031 exchange might be the answer you've been looking for. So, what exactly is a 1031 exchange? In short, it's a tax deferral strategy that allows you to sell one investment property and buy another without paying capital gains tax at the time of the exchange. This is a part of the Internal Revenue Code under Section 1031, and it's a powerful tool for real estate investors. Here's how it works. When you sell a property, you typically have to pay taxes on any profit you made. However, if you reinvest that profit into a similar property, what we call a like-kind property, you can defer those taxes. It's important to note that this doesn't mean you won't ever pay taxes, it just postpones them to a later date. Now, what qualifies as a like-kind property? The IRS is pretty flexible here. As long as the properties are both for investment or business purposes, they can be considered like-kind. For example, you can exchange an apartment building for a shopping center or a vacant lot for an office building. Even if the properties are different in nature, as long as they are held for investment, you're good to go. But there's a catch. You must adhere to certain timelines. After selling your property, you have 45 days to identify potential replacement properties and a total of 180 days to close on one of those properties. Keeping track of these timelines is crucial to successfully completing a 1031 exchange. Let's break it down with a real-life example. Imagine you own a rental property that you bought for $300,000. After several years, its value has increased and you decide to sell it for $500,000. If you sell it without a 1031 exchange, you'll owe capital gains taxes on that $200,000 profit. Depending on your tax bracket, that could mean thousands of dollars. However, if you decide to do a 1031 exchange and buy another rental property for $600,000, you can defer those taxes. This means you can reinvest all of your profit into your new property without losing money to taxes. This strategy allows your investment to grow more effectively over time. Now, let's talk about some key points to remember when considering a 1031 exchange. First, you must use a qualified intermediary. A qualified intermediary is a person or entity that facilitates the exchange and holds the proceeds from the sale of the first property until you purchase the second one. You can't have direct access to that cash. Second, not all properties qualify for a 1031 exchange. Personal residencies, for example, do not qualify. Also, you must be aware of the boot rule. If you receive any cash or other non-like-kind property in the exchange, that portion may be taxable. So, it's crucial to structure your exchange carefully. Lastly, keep in mind that tax laws can change. Always consult with a tax professional or real estate expert to ensure you're making informed decisions based on the most current laws. To wrap things up, a 1031 exchange can be an incredibly powerful tool for real estate investors looking to grow their portfolios without the immediate burden of capital gains taxes. By deferring those taxes, you can reinvest your profits into new properties, allowing your money to work harder for you. If you found this video helpful, please give us a thumbs up and subscribe to our channel for more educational content on real estate and investing. And if you have any questions about 1031 exchanges or topics you'd like us to cover in the future, drop a comment below. We love hearing from you. Thanks for watching, and we'll see you in the next video. Happy investing!